Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and we're going to be talking about money. We're attending at the 7th Annual Western Wealth Management Forum. And there was a huge emphasis on private credit, on private equity, on alternative investments, de-emphasizing stock holdings. It's not the first time we've heard this. Al's going to come back and talk about some of the insights from that and from other sources we've got. At the same conference, Touchstone Investments had done a survey of 4,000 financial advisor firms. And their whole focus was, how do you grow financial advisor revenue? How do you grow firms? Their solution? Dump a third of your clients. Get rid of the bottom clients and add a few top clients. That's the direct opposite of what we do at Adams Financial Concepts. But it is truly the industry standard, and it's what a lot of firms are doing. So you want to hear what Touchstone had to say, why we're different? Because we believe our approach is in the best interest of the client. But let's go back. And Al, talk to us about equities and stocks.
Well, should we take it back to 1979, Mike?
1979.
Do you remember 1979?
Yeah, I was young enough to remember. I'm old enough to remember that.
I think I was 7, so I don't remember it real well. But I went back and looking at things, and there was an article put out from Newsweek in 1979 with a big cover with a folded up dollar. Stock market certificate folded up as an airplane crashing, and it was called The Death of Equities.
Yep. Very famous.
Yeah.
Famous cover. Very famous story.
Yeah. And it just played on the idea that from the inflation from the 60s and 70s that equities were dead and people they were never going to return what they were going to, the 9 or 8% that they were returning. And that people started moving money to bonds, which were only getting 3%, and that was it.
Well, bonds were getting tanked at the same time because interest rates were going double digits.
Yeah.
But stocks had hit 1,066 and then went down 20%, then back to 1,000, then down 30%, then back to 1,000, then down 40%, then down back to 1,000 and down 20%. That's when that article was written. It's 13 years that the stock market had not been able to get over 1,000, and in fact at that time was down around 790. That was the Dow.
But the funny thing is, besides the years of 73 and 74, there really hadn't been many years of when the stock market, or the measured by the S&P 500, had declined more than 1 year in a row.
Yeah.
There was 39, 40, and 40, 39, 40, and 41, I believe. But, what was going on in 39, 40, and 41 is pretty unusual.
Yeah,
right?
There was a world war.
Yeah, exactly. And the other time is 2000, 2001, and 2002. Well, what happened then? We had the tech bubble burst. We had all those companies, Enron, Broadcom, and all that going on. And then we had 9/11 on top of it, which was a geopolitical shock that rocked things. We've never seen anything like that before in the United States. That really rocked markets, and so close to Wall Street. But other than that, calling for the death of equities back in 79, and just like the start of 2023, they were kind of calling the same thing. And that people weren't, that the market was going to tank, that it was going to continue to go down, that inflation was going to be persistent, which inflation might still be persistent. Who the heck knows? Nobody knows.
But if you go back to the 79 and think about it, we're 13 years from 1966 to 1979. And stocks haven't done anything. They got to 1,000 and they fell down. They got to 1,000, they fell down. They got to 1,000, they fell down. And if you're a stock market investor, if you're investing just in an index fund, you're feeling like stocks really are dead. If you're looking at it from a standpoint of the stock market, you think stocks really are dead. They've gone nowhere in 13 years. I mean, we're getting that same kind of impression in 2023, and out of that conference, that stocks are going nowhere.
But there were stocks back then that did well.
Oh, yeah. But you had to be in the right stocks at the right time.
Right.
But I mean, we've only been at this for what, 2 years? And already people are feeling like it's 1979?
People calling for that's stocks aren't going to do well, except for we've seen the Magnificent Seven this year do really well. The Tesla, the Apple, what's the other one? NVIDIA, Alphabet, NVIDIA, Meta
Netflix.
do really well.
Yeah.
Netflix. But other than that, for a while, it seemed like things were going to be flat, and that was carrying the market. And it's not really a good sign when you have that narrow a recovery. It speculates that a bubble's about to burst. And those companies, because the S&P is a market-weighted index, carried the S&P, made it look like it was doing better than it actually was. And that went on for quite some time. But then something happened in June, Mike.
What happened in June?
The S&P 500 as a whole went up 6.5%.
Yep.
Not just carried by the Magnificent Seven. And when they did a comparison and they broke it down to a one-on-one comparison, instead of just looking at the market as a market-weighted index, they did an equal weight index. There were more companies that were performing, 120 companies performing really, really well in the S&P 500.
That's a really significant difference.
That's a big difference than just a handful of 7 companies that would have massive, you all know them, they have $1 trillion market caps pulling the weighted index and pulling the, pulling it up.
And we've certainly seen that in our portfolios over the last 12 months. We took a much bigger hit in 2022, but we've seen a much bigger gain, and we don't own the Magnificent Seven.
We don't.
Whatever.
We have a couple of them are in there, maybe, but but we've seen a lot of broad-based companies do really well. The Nasdaq is outperforming the S&P. It's done really well this year. So,
but what we saw this past week is we're starting to see some of the Magnificent Seven come down. Netflix took a big hit on Thursday. Tesla took a hit on Thursday. So you have to think about, are they really fully valued, or are they just darlings of Wall Street that are going to crash?
Nobody knows. I think long term, I think they're all going to be really good stocks to own, especially with the advent of AI coming down. These guys are leaders in that market space.
A few are going to be good. I have a feeling there's going to be a few that don't.
Of the big 7?
Of the big 7.
Which ones do you think aren't going to do well?
I'm not sure that Netflix is going to have an ongoing presence. I'm not sure that Amazon's going to have an ongoing presence. Tesla, I believe, is a company that's dominating the EV market.
Why do you think Amazon and Netflix are not going to have an ongoing presence?
Amazon, except for AWS, is not making any money. AWS is a huge driver for their income and for the revenues. But they're not the cheapest, and we're seeing a lot of e-commerce companies come up and begin to nibble away and take some of the market share. And these are e-commerce companies that are specialized in certain areas, playing in niche areas, and Amazon wants to be everything to everybody. I
don't disagree. You think Shopify is going to take a big chunk out of Amazon's e-commerce? I mean, they're going to take some. Yeah, Etsy.
Walmart's going to take some.
Yeah, Walmart is really getting into that field. They've made a tremendous changes and tremendous strides in their business.
Target is working on the e-commerce side. So, I mean, sometimes that saying, the bigger they are, the harder they fall. I've been amazed at Amazon from the very beginning. I got excited about Amazon when it was a private company. And I remember thinking how awesome this company is, because I order a book, they get the publisher to send me the book, they just collect a fee, a brokerage fee for doing that. So I went to see them early on, I think in the first year that they were public. And what I found out is my concept of what happens was not what really went on. Mm-hmm. When I order a book, they had to order 144, 12 gross books from the publisher, and they were hand stocking the 143 books that I hadn't ordered into a warehouse shelf. Now, a lot of that has changed, but I could see my book, for which they probably made $15, was costing them several $1,000s in terms of labor and inventory cost. Now, they've developed a number of robots that handle the packaging and shipping. But I mean, in the early going, that's what it was. And I'm not sure a lot of that has changed. They've become more automated, but still, I don't see the profitability from their model. AWS, for sure. Mm-hmm. But if you have people nipping at your heels, taking away your e-commerce, and you're depending upon grocery stores, raises questions. Anyway, we're coming to commercial break. Don't go away. We've got more to say about the death of equities, for sure. Stay with us. We'll be right back.
About money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So, Mike, we talked about the 130 stocks that are trading. More than 130 stocks in the index have hit a 52-week high.
Yeah. From
the S&P 500. But more than that, on a technical indicator, the proportion of the S&P 500 stocks trading above their 200-day average, an indicator of market breadth, climbed as high as 65%.
That's
since mid-February.
Yeah.
So that's showing there's a lot more movement on the upside than they thought. And if we couple that with, we've kind of seen the banking crisis kind of subside. There might be another bank out there that has some problems, but for the most part, the SVB and First Citizens that's settled down. We're seeing potentially that the Fed could, even though they've mentioned they would like to raise rates 2 more times, we've seen positive economic data. We still have strong job numbers, and the consumer seems somewhat resilient to what's going on.
Stocks seem to be coming around.
I mean, just even more data. One that individual investors are increasingly putting more money into an exchange-traded funds that track broader indexes. Mm-hmm. It's according to Vanda Research. Net inflows from individuals into S&P 500 SPDRs ETFs trust surged in July and remain elevated versus last year's levels. And there's a lot of money in the sidelines that is still sitting out there that could potentially pour into these markets.
Yeah, there's a lot of money on the sidelines. A lot of people that have gone to cash. And this whole concept that it was a perfect trade. The short-term treasuries were paying 5.5, and the stock market was going to get suffered because of the recession, which still hasn't happened, probably won't happen.
Well, if it does, it's looking much more likely to be a soft landing, that it's not going to be this, slam the brakes on like what's happened several times before. Mm-hmm. I mean, who knows, right? We don't know that for sure, but it doesn't look like we're going to hit. And I don't know how you can if we don't see the unemployment rate start to rise, which we don't see that really happening.
No. There's 1.6 jobs for every worker in the economy now. That doesn't portend for unemployment rising.
No, and they're not low paying jobs either. These are good paying jobs. I mean, and just even if you just look at not factor out the tech industry and IT and all that, is they can't find people like welders and electricians, which now, I mean, which have always been, but they're really good paying jobs with good benefits, and they can't fill those positions.
Yeah. So that comes back then to the conference and the kinds of things that they were talking about.
What, you don't want to buy cell towers?
Tell us about the cell phone. You sat on that.
I sat on that. Yeah, it was interesting. It was, I'm always interested to learn about any sort of investment. And so these guys, they buy cell towers. And they buy them with the idea, they like to buy ones that aren't rented out. They like to buy them with, there's some space on them. Mm-hmm. And then they leverage them and they don't leverage them, they re-rent the space. And that's where they create their equity. And it pays a consistent payout. And they showed, graphs and charts of how it's done through inflationary times and down times because everybody needs their phone and connectivity. And so they showed how they bought one for, I think, like 2 or 3 towers for like $3 million, and it produced $130,000 of income. And then they added, I think, a couple providers on it, and then it went to it was worth like $7 million and produced about $230,000 of annual income. But the return is only made, they say 10 to 15%. And I 10 to 15%, that seems pretty high. That seems, if that's the case, that seems no less risky than stocks.
Seems a lot more risky if you really think about it.
Right. And so, I haven't gotten there yet. But the thing is that not only is when they say that it seems riskier, it's just is that my money is locked up. These aren't liquid investments. These are, I got to hold this for a certain amount of time. If I put 100,000 or 150,000 into it, it's I can't get it back out. I can't say, we'll sell 50% of it or 10%. I need some money.
It's locked up for 10 years.
Something like 7 or 10 years. Yeah.
So of the return, the 7 to 15%, how much is actual cash flow and how much
I think 5% is like cash flow. It's split it's almost split like 50-50 between cash flow and appreciation.
So 5 to 7% in cash flow and 5 to 7% in
and those
appreciation.
people, they make them sound like they're guaranteed, but they're not. Right? I've sat in a lot of these investments where they say, and one was with these guys that do real estate investments, not REITs, but they do what's called DSTs, Delaware Statutory Trust. And so you buy like into a warehouse or into a bunch of apartment buildings that are being built in areas, and they'll say we'll give you a 6 or 7%, but there's a range. It's like between 4 and 7. You could get 4, you could get 7, you could get nothing.
Yeah.
It's not there's no guarantees with these, and your money's locked up. I'm not saying it's a bad deal. I'm just saying that the client has to know the risks, that there are risks to it, but they put it out there like it's a lot safer than investing in stocks. I don't know.
I've been around a long time, and I think about the cell towers. Cell towers have been a marvelous investment, but if you look at the future, I mean, there's a plan to put up 60,000 satellites. And the idea is to bypass the cell towers completely.
Well, that's the thing. And Starlink is, right, the war in Ukraine is being fought off of Starlink. If it wasn't for Starlink, they'd be dead in the water.
Yeah.
Right? And one of the guys in the conference brought it up. He says, hey, I was out remote in the hiking, and I was able to get Starlink and get my location and get what I needed to get. And the guy was kind of arguing with him, well, that's really not that reliable. And he said, no, it was pretty reliable when I was out there. And they said that the cell towers, they said, well, the satellites won't be around for, maybe 15, 20 years or something. And he said, they're not going to compete with us. They're going to be a complement to what we do. And I'm like, why would they want to cobble on to that old technology if they're building I don't know what it costs to build a satellite. Let's say it costs $10 million to build a satellite. and I'm going to send it up, why would I want to cobble on to this old technology, 5G, 6G, whatever it's going to be? That doesn't seem to make any sense.
I have a Tesla, and the connection is to satellites, not through cell towers, but through satellites.
Mm-hmm.
And I have gone through some areas where there's not good reception for a short time, but that's only due to the fact that there's a lack of satellites. But when there's 60,000 satellites, you don't need the cell towers.
No, I think they're going to bypass. They're going to bypass that technology completely. And the cell towers they're ugly, first of all, and they need to put 1 million more of them because 5G doesn't have the bandwidth that 4G has. They need to put them like every, I don't know what it was, but like every 400 or 500 yards needs to be one to connect to 5G.
Yeah.
And I say they have this 5G, like my phone was 5G a year ago. I still see it go back and forth between 4 and 5G. It hasn't been that reliable. I haven't noticed any difference in my speed, anything.
Yeah.
0.
And with a satellite, you don't have to do a lot of hardware upgrades.
No.
I mean, and so the idea is that you'll get 5%, and then if it does work out that satellites overtake the cell towers and they don't need cell towers anymore, you wipe out your principal.
Mm-hmm.
When you look at stocks, yes, you always say that stocks can go to 0, but how many stocks really go to 0 and how many in a portfolio have really gone to 0? They don't.
No, I don't know. I don't know the answer to how many have gone to 0. I guess Bear Stearns comes to mind, and Lehman Brothers.
Even Bear Stearns didn't go out of business. It was acquired.
What's the one? The Enron, right?
Enron.
I mean, the possibility's there. Anything could happen. But the likelihood of companies going to 0, Amazon going to 0, even like you may downplay it, but as you said, their ASW is really valuable. It's a heck of a business, and that would be acquired or changed or bought or restructured or they split the company up and it gets someone else buys it up or whatever.
But it all comes back to the fact of this feeling that we've been in this time in which stocks have underperformed for 18 months.
Mm-hmm.
18 months, 2 years. It seems like a really short time when you think about it. It seems when you're living through it, it's been half a lifetime.
Well, it's funny you say that because I met with a friend of mine this morning that I haven't seen in a long time, and he works for this behavioral finance company, and we were talking behavioral finance. And we're talking about specifically talking to clients about, helping clients. And we talked about time frame, and he's like, Al, time frame. Clients see 6 months. Through anything beyond 3 years, that's like going to the edge. That's like going out into the end of the ocean.
Yeah.
They don't see past, 10, 20 years, 15, 10 years. That's an eternity to people. So like you said, you're right. I mean, when you're living in it, it's like it's lasting forever.
Yeah. And so they look to all sorts of different types of investments, which sounds so good.
And there's an ocean of them out there, Mike. There's so many. I mean, and it's not getting any less complex. Every day you and I wake up as someone's sliced the apple a little bit thinner and found a way to, now you can buy fractional shares of a company. You can do this. Remember, it was mutual funds, and then there was ETFs, and now there's, it just keeps going. There's always something for Wall Street to sell you. That's what it comes down to.
And it's always a chocolate-covered hand grenade. They are. They sound so wonderful. But if you don't really do the things, I'll leave one story before the commercial break, and that's back in the limited partnership time when it was similar to this. Limited partners were supposedly built on the idea that the general partner had the experience and the limited partners had the money. Turned out that the general partner ended up with the money and the limited partners ended up with the experience. Don't go away. We'll be right back.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So Mike, we're talking about the markets now, the markets in 79. And the reason why I brought up 79, I know it seems like an obscure time, but it's that if we don't look back and see, these things, what happened and how people reacted and responded, then, it's not going to help us, because they're not going to be, the future is not going to be the same as the past. We just know that. And trying to use past data to predict the future, there's some degrees of freedom there. One thing it does is, like, back then, like we just talked about the alternative investments, people were doing the same thing back then in the 70s. They were putting money into sort of real estate and things like that. Probably something like we just talked about, the master limited partnerships. I don't know if they were limited partnerships back then, but they were looking for all sorts of ways to make a buck that wasn't related to the stock market. But when they broke it down demographically, the funny thing is that people over 65, for some reason, stayed with the stocks. And I'm like, I don't know if it's because they were in pension plans or they were in locked sort of investments that they couldn't move. And the article didn't know either. If you go back and read the Business Week article, maybe we can post it to our website. If people want to see it, they can go read it themselves. But there were some changes in at that time, there were some changes to the ERISA rules and things like that came out that made things different for investors and how they could approach the market. So I don't know why that happened, but I'm sure those people over 65 benefited greatly by staying in stocks and not having to get out.
Well, and you bring up a really good point, because there were all sorts of different limited partnerships. I had a client that invested in a fish farm. They were going to raise salmon, and they had all this great background and how much they would make on salmon. And it was going to be just an awesome kind of investment. It was going to, because you could sell the fish, you had an income coming out.
Yeah.
And after 8 or 10 years, you could sell the fish farm to somebody else,
right, and
realize all your capital.
Yeah.
And all that sounded so good until El Nino came along and wiped out the fish farm.
It's funny you say that, because there was a guy I was talking to, he was investing in truffle fields.
Yeah.
In Spain, specifically in Spain. What's going on in Europe with the heat wave? I don't know how those have worked out. But I mean, there's been a shortage of truffle oil, so you figured I'll buy truffle. I think it was truffle fields. And I'm like, okay, they were growing truffles. I don't know what the cost is to maintain that investment and the variability in weather, and how do you.
And truffles are a mushroom.
Yeah.
And they depend upon weather. And they grow underneath moss and bog and so on. Mm-hmm. I know when I lived in France, there was a guy that had a pig that would sniff out the truffles. Those were wild truffles that they went after.
Well, it's like you and I met those guys one time at one of the money shows, the guys that were trying to get people to invest in rare wine.
Mm-hmm.
Where do you store? You got to store it. You got to keep it in the right place. You got to keep it at the right temperature. I mean, there's a lot of. I mean, if you're not planning on drinking it, I don't see it as necessarily as a long-term investment.
So, but people are looking for things because in the past 18 months, stocks have not performed well. So instead of looking at the companies and seeing companies make record profits, record revenues, and knowing that eventually that shows up in the stock price, they look simply at the stock price and say, gee, the stocks are not doing well. So,
yeah, and I've talked to people that have sold at the bottom of the market, and one cardinal mistake is to sell at the bottom of the market. I mean, you're better off getting in at the top, right? Because you get in at the top and the market drops 25%, and then when it starts to go back up, it usually goes past where it was before, and you're going to realize you're going to make money eventually if you hold it, if you have quality companies. But selling at the bottom and panicking is a sure way to lose money. Has
proven to be a very bad way to invest.
Yeah. So, back to, this is why, the article from 79 kind of reiterates at the beginning of 2023 that people call for the death of equities, and then we see what's happening right now. And everyone called for recession, that the stock market's going to go down again. And here we are, whether it's up, 18%? The S&P's up 18%.
It is.
This year already. And the NASDAQ's up, I don't know what it's 20-something, over 20%.
Down a little bit now.
Yeah. But still, overall up for the year. And it looks like from all the sentiment, it looks like it could continue.
Yeah. Which brings us to a change. I want to talk about the Touchstone investment, because they did a study. This also came out of the conference we were at. They did a study on how financial advisors can grow their business and be much more profitable. And they'd done a study of 4,000 different firms. And they claimed that the average rate for a financial advisor should be earning $884 per hour. I questioned that, but that's, if you work 1,625 hours, that means a financial advisor should be bringing $1.4 million in revenue for the firm. And at a 40% payout, that's $560,000. That's what they said should be the average. And yet, if you look at the average financial advisor, what they make in the state of Washington, it's $125,000, and nationwide it's $90,000. So what's the difference? And what Touchstone Investments was trying to say is, if you want to be at $884, they had a way in which to do this. They had the answer. How do you get there? Well, the first thing you have to do is you have to dump 1/3 of your clients. Now, 1/3 of your clients generate only 4% of your income. So by getting rid of 1/3 of clients, you create a lot more time to go out and get some higher revenue clients. And Touchstone's not alone in that. If you look at most of what's being preached in our industry, it's the same thing. Categorize your clients into A, B, and C, or A plus, A, B, and C, and deal with each of those categories in a different way. We're just the opposite of that. Absolutely the opposite of that. We don't classify our clients. We like to see our clients grow in value. But Touchstone's not alone. I questioned Touchstone. I said, we are the difference. But the focus in that standard is classifying clients A plus, A, B, and C. And I take an example from another study that I looked at. A plus clients had a minimum of $4 million at the firm. A had $2 million at the firm. B had enough money to get to A plus or A, and C clients had a minimum of $500,000, but probably would never be able to get their accounts to $2 million. And there are firms now where they put C clients at $1 million and raise those numbers up. And by Touchstone's analysis and how they structured what financial advisors have to do, you treat clients differently. A clients, and they only had A, B, and C. They didn't have the A plus, but their A clients got 2 in-person meetings a year. They got 2 virtual meetings. They got 8 phone calls or emails in a year. Their tax documents were hand-delivered to their CPA. They had at least 2 client appreciation events that they got invited to. And they should average about 10.4 hours per client. That's an A client. A B client, 1 in-person meeting, not 2, as the A clients got. 1 virtual meeting, not 2 like A clients got. They got 4 phone calls or emails, half of what the A clients got. They got their tax documents mailed to the CPA, not hand-delivered. They got 1 client appreciation event in which they were invited to. And for them, the advisor should spend about 4.9 hours. C clients didn't get any personal meetings. They got 2 virtual meetings. They got 2 phone calls or emails. They got their tax documents mailed to their CPA, and they never got invited to a client appreciation event. And they get 3 hours. Now there's blending that goes on, and a lot of financial planners will make sure that there's at least 1 in-person meeting. But essentially, that was the focus of what Touchstone was saying. The focus is on planning and asking clients to add to their portfolios. Doing asset allocation. They wanted to do something where the assets are not correlated, so that one one asset class goes up, another one goes down. The idea is not to lose money for clients and to reduce the volatility. But in doing that, you sacrifice return. So the studies like have been done by SEI and some of the other firms that actually study how firms perform for clients, the average is around 5%. And the returns actually have been declining since 2019. Consider that inflation is 5%. 5% is just staying up with inflation. And if you're less than 5, you're going backward. For clients to move from C to B to A, clients have to add money. It's not a situation where the clients are growing. Our approach is exactly the opposite. If a client comes to us with $500,000, we feel the responsibility to see it to grow to $4 million over the long term. And we grow wealth slowly. We're not here to grow $5 million or $500,000 into $4 million in 2 years. It takes time to grow. But the fact is over a period of time, portfolios do grow. And yes, we have greater volatility. But $500,000 at 5% over 25 years will grow to $1.6 million. At 15% will grow to $5.4 million. Which would you rather have? What you give up is greater volatility. What you gain at the end is much more wealth. Clients don't go away. We've got a lot more to say about this.
About Money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So I've been talking about the Touchstone investment, where they said in order to grow your business, you need to dump a third of your clients. We don't do that. They said that you need to classify your clients into A, B, and C. We don't do that. They say that you need to treat clients that are A clients differently than B clients than C clients. We don't do that. But are we just talking the talk, or do we walk the talk? So I thought we can show what we do. And I looked at where we are. We had 4 clients that died this year. We didn't have any the last couple of years, but very, very sad. Clients that have been with us for many years. We had one client that had only been with us for only 3 years, and she passed away, so I didn't use the data there because it's not long term. But when I look at one client, and I only took the time from 2010 to 2023, 13 years. The first client had been with us since 1986. Had started with, I think, around 20,000 to 25,000. By 2010, that had grown to 294,000. In 2010, we converted to a fee base from a commission base because in the beginning, she was strictly commission-based. We tracked the fee-based accounts. We were all fee-based since 2010. Her account started at $294,417. The ending value was $1,937,270. The gains on that $284,000 over 13 years were $1.6 million, $1,642,853. We had another client. She started with $193,174 in the beginning of 2010. She ended up with $742,283. Gains $549,109. Both of those clients were conservative clients, and their focus was on growing wealth slowly. Third client started with $136,488. Added actually in 2013 $317,438. But during that period of time was taking income out of the account, was taking $4,000 a month out of the account, $48,000 a year. Over the period of time, they took $463,439 out of the account. The account ended up starting at 136, adding 317, ended up at 417,927. And that was not the peak of the account. So it's not that we just talk the talk. We actually walk the talk.
Walk the walk, Mike.
Walk the walk.
Don't
Okay.
don't walk the talk.
And the idea is every client that we sign, our contract says our goal, and we seek to beat the S&P 500 total return. I just looked at a website the other day. The website showed the advisor had outperformed in 2007 to 2009, had a positive return. In 2010 to 2019, had a positive return. In 2020, had a positive return. Had a positive return in 2022, 2023, and was comparing that to an index. And the index they chose was the hedge fund index, which maximum value during that period of time was 3.5%. So we're looking at the S&P 500, average return 17%, not 3%, and not an average of 1.5% or 2%. So you also have to be very aware of comparisons. I thought it was a unique presentation. We always have positive returns. We beat the index. There's something like 13 million indexes, so you can pick one that no matter what, you can beat. But we're concerned with inflation, right?
We are.
Doing 5% does not get you any growth over inflation.
No, especially if it persists for the next 5, 6, 7 years. Who the heck knows how long it's gonna take to shake out of the economy?
And it is going to take a long time to shake out of the economy. You know, you talked about the number of jobs that are being created. In order for interest rates really to impact, you have to impact businesses and you have to see negative growth almost. That's not happening. Companies are reporting record profits, record revenues. Not every company.
Mm-hmm.
But you mentioned, what, 120 companies?
130 companies.
130.
They've hit all-time highs in the S&P 500.
Yeah. That does not sound like the recipe for a recession.
No, it doesn't.
Does not sound like a recipe for dealing with and reducing inflation.
And just look at, as we talked about, travel. Travel's just off the charts.
Yeah.
Maybe it's not people aren't buying stuff, but they're doing stuff and spending money.
I talked to a travel agent, and she said she is busier right now than she's ever been. But coming back to inflation, I thought it was pretty unique the way they reported the numbers. In the past, they've reported out 2.0, 2.2. This time, 0.158, 3. They're going out to the third digit. So if they gain a couple thousandth of a percent, they're happy. They're dealing with a very, very difficult situation. They're dealing with something that's never happened before. And a lot of it has to do with the fact that we came out of the Great Recession. The Obama administration wanted to create jobs, and they did. The Trump administration made a priority to create jobs, and they did. Biden administration made a priority of creating jobs, and they are. Nobody is talking about, you know what, it would be really good for us to have fewer jobs.
Yeah, no, that's a hard sell. It's like nobody wants, no politician wants to do that or take the pain for paying down the debt and raising taxes and do what needs to be done.
Yeah.
I think Volcker was the last one.
He was. He understood that he had to raise rates to a point where it was painful.
Mm-hmm.
And we're in a situation, I think, with a presidential election coming up in 2024, in this coming year, that nobody wants to take a decision to do something that's painful. They'd rather see a little bit of a reduction of inflation from 1.82 to 1.58. 0.158. I find that very humorous. But that's where we are. As Al talked about, we're seeing people look at alternatives to stock market because it's been a difficult time for 18 months. And when our time frame starts to be 18 months, we start to lose sight of the long term. It's no longer a buy and hold, no longer a look to the long term. It's what can you do for me today?
Yeah, I mean, I also think, there's a psychological effect to all this, right? I mean, I wonder if people just looking back and seeing that these things end, that we know that we come out of these recessions, we come out of bad periods of the stock market, that people just are trying to ride right through this. I don't know, because they keep on spending money, so I don't know. And credit card balances keep going up, so...
We live in a very special time. All we want to do is make money for our clients. That's our focus. Have a very good week and a great weekend. And we will be back next week to talk about money.